Silver has already escaped its cage. For half a century, silver went nowhere on purpose. It churned, stalled, exhausted investors, and trained everyone to stop paying attention. That was the deal. Stability on the surface, control underneath. But now here's the contradiction no one prepared you for. While most people still believe silver is irrelevant, its market behavior has quietly flipped into something fast, vertical, and unstable. You can see it in the rhythm. Moves that once took months now compress into days. Pullbacks that used to breathe now snap back almost instantly. That isn't strength, that's pressure releasing. And this matters to you because markets don't warn before they reprice. When long-term ranges fail, price doesn't negotiate. It resets, suddenly, permanently. Silver is now detaching from decades of historical limits and entering a new phase where old ceilings stop working and psychological levels lose control. Once that transition completes, the next move doesn't grind higher. It launches. But here's the part nobody is saying out loud. Silver isn't leading this shift. It's reacting to something much bigger already breaking behind it. What just triggered this isn't a single headline or a one-off trade. It's a pattern snapping into place. The core event looks simple on the surface. Silver prices began behaving differently late last year. Volatility compressed, breakouts stopped failing, corrections stopped lasting, but that's only about 60% of the story, and it's the least important part, because silver didn't change on its own. It moved as part of a broader shift where capital started questioning the safety of things that were never supposed to be questioned. Bonds, currencies, sovereign guarantees, the assets people treat as boring because they're safe. Notice how the conversation stayed narrow. Most coverage framed this as a metal story or an inflation hedge story or a speculative trade. But here's the reframing that matters. What if silver isn't being bid up because it's attractive, but because something else is quietly being rejected? That question changes everything. If money is starting to exit long-trusted systems, it has to go somewhere. And the places it goes first aren't always obvious. Now watch how fast this escalates once you look at the first hard proof. Here's the claim that changes the story. This move isn't being driven by optimism. It's being driven by withdrawal. Large players aren't positioning for upside. They're pulling away from exposure they no longer trust. And you can see it in what's missing. Instead of paper promises changing hands, physical material is being removed from circulation. Inventories that were once treated as untouchable buffers are shrinking, quietly, consistently. When institutions stop rolling paper claims and start prioritizing what they can physically control, that's not speculation, that's risk management under stress. Here's why that matters. Paper markets only function when participants believe settlement will always be easy, abundant, and delayable. But when demand shifts from price exposure to delivery certainty, the entire structure changes. Liquidity becomes conditional, volatility becomes asymmetric. Now notice what didn't happen. There was no public panic, no official warning, no emergency meeting. That silence is the signal. When stress builds without headlines, it's usually because the most informed players are moving first. And once physical demand replaces financial convenience, price stops behaving politely. This is where the story stops being about silver and starts becoming about system limits. This is where the escalation becomes impossible to ignore. What started as quiet withdrawal begins to compound. As more capital moves defensively, the systems designed for smooth, continuous trading start behaving erratically. Price discovery slows, spreads widen, small disruptions stop being absorbed and start rippling outward. We've seen this pattern before, not in metals specifically, but in moments where financial structures assumed infinite liquidity right up until they didn't. When confidence fades, markets don't break all at once. They normalize stress first, delays become routine, volatility becomes expected, emergency measures start sounding reasonable, and that normalization is the danger because once instability is treated as normal, thresholds vanish. What would have caused alarm years ago now barely registers. The system keeps operating, but with less margin, less trust, and less room for error every day. Here's why that matters now. Silver sits at the intersection of finance and reality. It's traded like a financial asset, but consumed like a resource. When stress migrates from abstract balance sheets into real supply chains, there's no rewind button. This is where the story flips. The pressure doesn't dissipate, it migrates forward. Now the evidence gets harder to explain away, because at the same time confidence is thinning in financial structures, the physical side starts sending signals that don't line up with the calm narrative. Availability tightens, delays stretch, premiums detach from headline prices, and suddenly the price everyone sees on a screen stops reflecting what it actually costs to obtain the asset. Here's the contradiction that locks this in. Publicly, the system still speaks the language of abundance. Smooth markets, deep liquidity, efficient settlement, but operationally, behavior changes. Participants begin protecting margins, processing slows, cash flow gets guarded. These are not the actions of a market expecting stability, and this is the line that permanently reframes the issue. When the price is stable but access isn't, the price is lying. That gap between quoted value and real-world friction isn't a glitch. It's a warning. It tells you the system is absorbing stress by hiding it, not resolving it. Notice what's missing again. No official admission, no acknowledgement that something fundamental has shifted, just quiet adjustments behind the scenes to keep things moving one more day. But systems can only compress reality for so long before it forces a reset. And once that reset starts, it doesn't respect the old numbers. Now everything starts speeding up. Multiple pressures begin stacking at once, and none of them wait their turn. Industrial demand doesn't pause to check prices. Supply doesn't scale on command. Financing tightens. Processing bottlenecks form. Each issue alone would be manageable. Together they start feeding on each other. What matters here is speed. Contracts get extended early. Materials get locked up longer. Inventory that once circulated freely gets pulled forward and held. The market loses flexibility, and with it, the ability to smooth shocks. At the same time, participants stop acting like this is temporary. Decisions shift from optimize later to secure now. That's a psychological break. It signals a loss of confidence in future availability, not just current pricing. Here's the dangerous part. None of this looks like a crisis yet. It looks like logistics, like caution, like prudence. That's why it spreads. Because while everyone waits for a headline event, the system is already tightening its own constraints. And once momentum turns from price-driven to availability-driven, control slips fast. Now bring it back to you. Because when systems tighten, the effects don't stay abstract. They show up in ordinary decisions. Higher costs pass quietly downstream, fewer choices, longer waits, rules that change without notice. You feel it not as a crash, but as friction creeping into everyday life. When access matters more than price, the advantage shifts away from institutions and toward whoever moves early. Everyone else pays in delays, premiums, or missed opportunity. That's how pressure redistributes itself, not evenly but selectively. This isn't about ideology, it's about how real people adapt when confidence erodes, savings stop feeling secure, planning horizons shorten. People begin prioritizing what they can control over what looks efficient on paper. And notice how familiar that feels. If you've ever sensed that the official story didn't match lived reality, that things felt tighter even when numbers said otherwise, that's this dynamic at work. This is where personal risk quietly enters the frame. If this feels familiar, say so in the comments. Because what comes next isn't driven by emotion or panic. It's driven by structure. And once structure shifts, outcomes follow whether anyone agrees or not. Here's the part that rarely makes it into headlines. This doesn't happen because people suddenly panic. It happens because systems reward the wrong behavior for too long. Leverage gets cheaper than restraint. Speed gets rewarded more than resilience. And visibility replaces stability as the primary goal. When those incentives dominate, the system becomes fragile without looking fragile. Everything works until it doesn't. And when stress finally shows up, the response isn't correction. It's containment. Freeze here, patch there, buy time. That's the mechanism. Pressure isn't released, it's redirected. Assets that exist only as entries in a ledger depend on trust in every intermediary between you and settlement. Assets that exist outside that chain don't. That difference becomes decisive when confidence thins. And here's the unsettling insight. The system doesn't need to fail completely to change behavior. It only needs enough doubt to alter incentives. Once participants start prioritizing control over yield, everything downstream reprices around that choice. This isn't a moral failure or a conspiracy, it's a mechanical outcome. And once enough actors adapt to that reality, the old equilibrium can't come back. Now the only question left is how this resolves. From here the path splits, but neither option restores the old normal. One path is slow stabilization. Interventions hold things together just enough to prevent a visible break. Liquidity is supplied, frictions are managed, volatility is dampened. On the surface it looks like control, but underneath confidence keeps thinning. Each fix requires a bigger fix next time. Each patch reduces future flexibility. The other path moves faster. Stress compounds. A single failure forces a visible adjustment. Prices jump, not because demand explodes, but because availability suddenly matters more than modeling. That kind of move doesn't wait for consensus, it forces it. Neither outcome is clean, neither is predictable in timing, but momentum is already forming, and momentum doesn't reverse because people prefer comfort. Notice what's happening now. Decisions are being made earlier. Positions are being secured sooner. Optionality is shrinking. Those are not defensive reactions to noise. They're responses to trajectory. And once enough participants start acting on where things are going, not where they've been, the next move is no longer hypothetical. It's already loading. Here's the insight that ties all of this together. What looks like a story about silver is really a story about trust leaving systems quietly before it leaves prices loudly. Markets don't break when everyone panics. They break when confidence drains out slowly and nothing steps in to replace it. That's why this shift feels subtle but irreversible. Once behavior changes, numbers follow. Not immediately, but inevitably. The real signal isn't where price is today. It's what participants are no longer willing to rely on. When control becomes more valuable than efficiency, the system has already crossed a line it can't uncross. This isn't the end of a cycle, it's a handoff between rule sets. And the reason this matters is simple. Most people only react once outcomes are visible. By then, the leverage is gone. If you want to understand how this transition continues and where pressure moves next, that's what we'll be tracking. Follow for the next layer. Because this story isn't resolving, it's unfolding.